Phil Muscatello and Finpods are authorised reps of Money Sherpa. The information in this podcast is general in nature and doesn't take into account your personal situation. Shares for beginners. Weekend Watchlist.
G'day and welcome back to Shares for Beginners Weekend Watchlist, where we take a close look at an individual company that you may wish to consider for your watchlist. It's not a recommendation to buy, but a way for you to learn how Stockopedia screens for value. Joining me today is Elio D'Amato, and we're talking James Hardie Industries, ASX code JHX. G'day, Elio.
Yeah, g'day, Phil. Thanks for having me on. And I thought it would be appropriate to talk about JHX today, given that we're saying goodbye to SR, what was known as the Colonial Sugar Refining Company, as it was known when it was formed back in 1855, and Adbury, of course, the old Adelaide Brighton, which was founded in 1882, and Boral, which will be gone soon after, and that was founded in 1946. So look, there aren't going to be many building materials stocks on the exchange left, but James Hardie will be one of them, hence why we're talking about it today.
And they have a lot of history, don't they? Not many people remember. I mean, it is ancient history now, let's face it. It was a long time ago, but there was the asbestos situation, wasn't there?
Yeah, there was. I mean, look, today, of course, James Hardie is known as a building materials business, and it's actually headquartered in Ireland, which can scratch the heads of many investors that are out there, particularly when you think that they're dual listed, not only here in Australia, but in New York as well. I think its management team are actually in Chicago, if you can believe that. But anyway, for those investors long enough to remember, and Phil, unfortunately, I think you and I fall into that bucket, but obviously there was a time where it was basically plagued by several asbestos-related scandals, particularly in the 20th century. Now, most significantly was a cancer that was called mesothelioma, and I'm not going to bore everyone to snores, Phil, in regards to what actually happened, or what they were building, but back then, they were using asbestos in a whole range of materials like cement sheets, plumbing, insulation, brake lining, basically anything that needed to be heat resistant. Well, asbestos was in it. So it seems ludicrous looking back today.
How many buildings now, when you demolish a building, how careful you got to be with asbestos, you know?
Yeah, exactly. Yeah. It's just mind-boggling. But back then, it took a number of inquiries, actually, some sackings, a court case, lawsuits, and ultimately jail time to convince the corporate world and those builders that are knocking those old houses down of the scourge of asbestos. And what really upset investors, I think, at the time was, as the scourge of asbestos started to become obvious, the company was beginning to structure up its subsidiaries so that it would ring-fence asbestos claims against it. It moved to the Netherlands back in the day, but that was apparently to save tax, but it lost the court case with the ATO, which effectively meant they cost them the same amount anyway, and that was a complete waste of time. And eventually, they've now moved to Ireland. So, look, during this whole time, they lost the PR war, and ultimately, they would have former directors thrown in jail, and the trust fund was established, called the Asbestos Injuries Compensation Fund, and that is actually running still today. And look, fast forward to today, and obviously it's tried much to distance itself from its dark past, and for good reason. I mean, asbestos is no longer used in any of its products, but even in the company's latest results, the stench is still felt a decade after the last court case was actually held. So there are a number of adjustments still made on account of it. So in our view, the asbestos issues acted as an anchor on the business for a very long time. And from that point of view, basically you look at the stock at the moment and it's increased tenfold from those dark days. So the stock, recently in our view has been pulling back though. Investors may be asking why, and possibly even asking themselves, is now an appropriate opportunity to buy a James Hardie, which is very different than what it used to be.
After our conversation earlier this week, I might just point out that it's below its 200-day moving average, which in the technical world doesn't qualify it very highly for a buy.
That is correct. So obviously sentiment is running against it. It's had a good run to get to this point. Pats on the back all round to those that have enjoyed that. But as you touched on, Phil, we've discussed how a common strategy used amongst technical analysts is to basically never buy a stock that is trading below its 200-day moving average, because that would suggest that the sentiment is obviously against this business. And James Hardie fits into that. I mean, for momentum investors, the stock at the moment is in a short-term downtrend. That is further exacerbated by the gap down that we saw when it released its half-year results, where basically profits for the full year were flat. And seriously, in the current environment, that is hard for many to stomach, particularly when you've got to pay upteenth amounts for building materials just to get a house built, and we've seen all those builders go broke. Obviously, that was probably not what the market wanted to hear. And despite the fact that the company actually improved its EBIT margin in the full year, it was sold off quite extensively. And there was some outlook statements, particularly in regards to expected volumes coming. They were expected to drop some 5% here in Australia over the next year in what it would call a difficult market. For when basically house prices are too high, it does curb demand. Now, personally, I don't believe that, because I see on the ground the amount of homes that are desperately needed by many Australians. But then again, only 20% of all sales for James Hardie come from the Asia-Pac region. The vast majority come from North America, which is around 68%. And I think that's going to be more relevant, particularly what happens over there at the moment to what occurs with this business. So, yep, you're right. You're not trying to catch a falling dagger with this one here if you're a technical analyst. But sure, if you're a fundamental analyst and you appreciate and accept the fact that we need somewhere to live, irrespective of whether you buy it or whether you rent it, then maybe someone like a James Hardie could be appropriate for you, because there are some markers which look relatively decent.
And the recent price decline coincided obviously with the latest reporting, which is on a US financial year cycle, isn't it?
Yeah, exactly. That's right. And that makes sense because of that dual listing, as I talked about, notwithstanding the fact that it's based in Ireland and headquartered there. But you're right that obviously they've linked themselves up. So they have this unusual habit. There are some stocks on our exchange that do this, but they report after March and after September. So they don't have the usual June, December sort of cycle. And therefore, as a result, it basically keeps analysts like us on our toes that we can analyze it. And you mentioned that it was disappointing in regards to its price. I mean, it fell something like almost 15% on the day, actually, when it released its half-year results, and it created a lovely little gap, which, again, using technical analysis parlance, there'd be those that saying that that gap needs to fill before there is any clear direction either way, notwithstanding the fact that it's going down at the moment, and possibly could be a more elegant exit for those that are looking to get out of the stock if that gap gets close to being filled. But obviously, we're still some time away from that. So, look, forecast-wise, again, the analysts may very well have savaged the stock, and we've seen EPS hit quite a bit. But you know what? I still see a company spitting out a lot of cash. And, you know, quite frankly, even though $3.5 billion, I think the reports were showing, vanished from the market that day in regards to James Hardie, I think that volatility can possibly create an opportunity for a savvy investor at the moment who may be looking at the underlying business and the underlying demand for what it is they have, which, let's face it, still remains relatively strong.
So looking at the Stockopedia scores, even after the recent price decline, it's still trading on a low value but a very high quality score.
Yeah, that's right. The quality score that you mentioned, Phil, is really what we're hanging our hat on here in regards to James Hardie. And that is notwithstanding the forecasts, the naysayers, the noise that's out there. When you look at the underlying numbers, the business is actually still quite sound. And obviously, this includes the latest half-year result where we saw that price savaged as we did. And I mean, we're talking about a return on capital of some 18.6%. We've got return on equity of nearly 30%. They've got good operating margins. And as I talked about, they're able to expand their EBIT margins. From a Piotrowski F-score perspective, they rank a 7 out of 9, which is quite high. They're not likely to go bankrupt, according to Professor Ed Altman, and their cash manipulation is actually low, whereby much of their profitability is actually being transferred over to cash flow, which is just what you want to see. But of course, as you alluded to, Phil, I have talked about today in regards to the positive outlook, value is still skinny. So are you picking up a stock here dirt cheap? No, you're not. You are having to pay up to play in regards to this business with a quality outlook. The value at the moment rates are 35, which isn't the highest ranking, but at least it's been stable. Unlike momentum, on the other hand, whereby obviously, as investors can see quite clearly on a chart, and you don't need a degree in financial or technical analysis to be able to determine this, it's off its highs. It's currently rating a 43 on a relative basis against the market. It's not done all its best, particularly over the short term. It hasn't done particularly well against the broader market, and that really has had the effect of dragging the overall stock rank down to 59. So in sum of all that, if the price stops falling and goes the other way, then obviously this becomes a stock that is going to be highly talked about as being a good quality business and the price doing the right thing. Yes, value might get a little bit harder, but then again, there might even be some more value appearing if the share price decline continues. Ours is not to judge as to what will happen. Ours is to basically reflect what is happening at the moment. And obviously, the trend is not your friend when it comes to James Hardie, as you've already alluded to.
Are you picking shares on gut instinct? Buying on press tips or rumours? Do you struggle to find the time to keep up with the research and analysis that goes into evaluating potential stocks? Stockopedia are pleased to offer a special deal to listeners of this podcast, a 14-day free trial and a 10% discount on the first year of membership. Sign up now at y.stockopedia.com/SFB. There's no better time to access the most comprehensive, easy-to-use investing toolbox for DIY share investors. 10% off, 14-day free trial and a 30-day money-back guarantee. That's y.stockopedia.com/SFB. So Elio, let's have a look at those numbers that lead to these scores and what you're thinking about this company.
Yeah, sure. So obviously I touched on the growth elements already. And to be frank, basically the strongest that we have for the particular company. So if we can look past quality at the moment and look at valuation, because everyone wants to know the value of a stock. And currently it's trading on a forecast PE just below 20, which is, let's face it, for those that have studied the old textbooks, as it were, buy with a PE under 20, never above. Well, look, it's just below that. So obviously that's a little bit of a concern for some investors, but possibly more of a concern from my perspective, if you're looking at value, is the EV to EBITDA. Currently forecast to be 13.36 million. But then again, look, I'm looking at a business which has grown its sales on a CAGR perspective, which is a constant annual growth rate perspective, over the last 5 years of some 9.45%. EPS has also tracked in the right direction, and EPS growth has done just as well, notwithstanding the concerns that have been voiced by the company on possible volume growth. Again, I'm going to want to see evidence of that before I necessarily suggest that that is actually in train. Look, when it comes to return on assets and, things like return on capital employed, they're still quite elevated relative to the sector and what it was, but they have pulled back in recent times. And of course, for our dividend-seeking friends out there, you're probably not going to be looking at James Hardie because, of course, one, the dividend's not franked, but two, it's anemic and basically doesn't exist. So I therefore think that you're probably going to give this a wide berth from an income perspective, and it does focus more from a growth perspective. Now, I did talk about those relative measures, Phil, and I just want to spend a little bit of time talking about that because the things that I suppose are a little concerning at the moment. It's had a good year. I mean, relative to the market, it's done better than 13%. Obviously, over a 1 month, it's underperforming the market by 10%, and the market's defined by the All Ordinaries, I should say. Over 3 months, it's down by 19.5%. And look, it's some 20-odd percent off its 52-week high. And as you've already alluded to, the price is below that 50-day moving average, which is not 100% great as well. And I've also seen that the volume, and I know a lot of investors like to look at the volume of a stock as well as its price in order to get a gauge as to what the sentiment is at any particular time. Well, obviously we can see that the volume's starting to increase, and you don't want to see that when there's a downward trend, because when there's a downward trend and the volume is increasing, that would suggest that actually more people want to get out than actually want to get in. And that's definitely not the scenario we want to be in. So Again, in regards to its actual half-year result, I had to be quite happy with it, to be quite, if I had to be brutally honest. But of course, that's backward-looking to a certain degree, and investors are always forward-looking. And if the price can stay above the level of the recent low, which just sort of sits around that $46 mark, then I think that'll be its reprieve, and at least it'll have a solid basing. And let's face it, the share price sort of has gone sideways since that half-year result. It hasn't really done all that much, which is a good comforting thing for those that are true believers, as it were. But for those that like to look at the squiggly lines, then you're obviously looking at the 50-day and 200-day lines converging, and the price has got to hold that $46 mark in order to be safe. But I will be watching that 15% gap that was created when it did release its result later towards the end of May. Hopefully it was just a bit of an aberration, but you never know. The numbers don't lie. But otherwise, in regards to all those other metrics like profit, sales, etc., there's not really much you can fault James Hardie on.
I'm not sure if it's a similar situation in the United States as it is here, because we're talking about building company collapses, the increased price of building. People can't afford to renovate. People can't afford to build. The building industry, it's very, very difficult to actually build a new home these days here in Australia. Is it the same in the United States? And does this have any material bearing on James Hardie?
Yeah, the quick answer is yes, it definitely does. One, the phenomenon is being experienced over there, and we're also seeing the company acknowledge that, and therefore saying that it could be a bit more of a challenging environment for them going forward. I mean, the company has stated, and it did so again in its half-year report, that basically one of the key risks to their business is that it is dependent on the residential and commercial construction markets. And obviously things that impact that are going to impact its business. And I've been looking at as many balance sheets over the years and P&L statements to definitely enough to, cure insomnia for a lifetime. Or bring it on, whichever the one of the two you want to do. And I can tell you that a common trait amongst many of the failed entities that are out there are the fact that there seems to be a disproportionate, a large amount that are actual people that are builders. You can extend that to engineering firms and the whole like, but obviously builders have a challenge because, of course, imagine, Phil, you sign the contract to build a home today, but it actually doesn't see the dirt turned over for another 2 years, if not 3 years. So in a period where we've now seen this extraordinary inflation where apparently the price of everything has gone up, what that has actually meant is that effectively if you're a builder who signed a contract 3 years ago, you can't afford to build a new home today. Or if you can afford it, you're basically using any possible future sales in order to offset the rising costs. And let's face it, James Hardie has been very good at passing those costs to customers. And we've seen evidence of that in regards to their numbers, whereby seemingly, again, if you were able to block out the real world and what's occurring around us, things are going quite peachy there in regards to their operations. But obviously they see a bit of a strain in regards to, things like delays and cost overruns. And as you alluded to, North America is so important to them. I think 68% of total sales come from that particular region of the world. So anything unforeseen is going to be a problem. Now, you see anything that is seen that you can see as an analyst, I usually don't have a problem with because you can factor in and price in all the items that are basically known knowns, as it were. It's when you get those known unknowns, to use another famous old school quote, if I can, Phil, that obviously that is when you get those troubles. And obviously what is occurring in North America is going to have a big impact in regards to James Hardie. So, yep, it looks pretty similar in regards to what's occurring there. Yep, the challenges are exactly the same in what's occurring there. Throw in an actual presidential year, that is another issue that's going to possibly cause some volatility in regards to their earnings. And therefore, as a result of all that, James Hardie's outlook, unsurprisingly from the CEO, was a little somewhat mooted. And one would have to basically go against that view if they're going to consider an investment in James Hardie right now. Because, of course, if they continue to bleed sales, if they now start to lose money, then obviously that's going to impact their business. And as I said, they were right on the borderline at the half-year results, so they're really teetering on the edge somewhat. So to use Clint Eastwood saying, are you feeling lucky, punk?
Yeah, well, it sounds like that kind of ambiguity that you've got in this stock. Are you feeling lucky, punk? On one hand, it's a great quality company, but then on the other hand, there's a lot to watch out for.
Yeah, there is. And, they talk about those other risks in regards to, third-party distribution channels. Obviously, any COVID-related sort of event or anything like that's going to impact them because, as I said, they are out of asbestos now, but they are in fibre cement. Well, obviously, that large part of that, they're going to have to import their goods after making them elsewhere, etc. So that is obviously going to impact them highly. Things like severe weather events, which of course North America have been known to have in recent past, and we've seen that with a number of insurers, including a QBE, I think, who delivered an updated result, although I did note New Caledonia had a disproportionately large impact on their bottom line. But anyway, I digress. That's another business, and I don't want to talk about that. So obviously, what's occurring there, those sort of events do hit. And yeah, you can see your climate change and then a whole range of other statements. But really, it comes down to what's occurring on the ground at the moment, particularly in North America. Even though here in Australia, things are expected to ease somewhat, which is a bit contrary, I suppose, to the budget aspirations of us having X amount of new homes in the near term to solve our own home housing crisis, as it were. We're likely to see that somewhat in the US as well. But again, for investors that can take a view that's longer than their nose, as it were, then there very well may be. It's better buying now than what it was, say, 3 months ago. And I don't think there's anyone that can convince me of that.
So this episode is coming out on June 22nd, which is 8 days left to go in the financial year. So, Elio, just remind us again of the end of financial year Stockopedia sale.
Yeah, Stockopedia does have that end of financial year sale. And again, I'm not going to cover too much in regards to the details, in regards to the offer, but essentially it's cheaper. You get free books and there's a stack load of education. So for all of that, you can save upwards of 15 to 25% on your first year subscription. So all you've got to do is go to the website y.stockopedia.com/EOFY-24. I'm sure there'll be a link attached to this podcast, Will, and you could basically avail yourself of that package. And I think it's a great time to do that because any mug can pick stocks, right? That's quite easy to do. But when it comes to managing money, that is a whole kettle of fish. And as managers of our future prosperity or our family's future prosperity, it's cognizant and important on us that we actually take an active interest in what we actually invest in and therefore what we generate as a return. And you can get that sort of clarity by looking at the numbers because unless you got yourself a creative accountant, the numbers don't lie. And that's one of the great things that I love about Stockopedia, that I am able to analyze all the companies in my portfolio, continually monitor and manage them. And then, of course, have both Chris and myself, Chris, who also appears on this podcast quite regularly, answering any questions that you may have about your investing, combining our 40 years plus experience, all to deliver you that information that you need. Not personal advice, though. We don't do that. But obviously, we lay the cards on the table for you to effectively make an informed decision that basically you need to act on. So, yeah, Phil, it's a great time to consider Stockopedia right now if you've been listening to us talk over the many weeks and months. And, yeah, hopefully I get to welcome as many weekend Watchlist listeners into the Stockopedia family as soon as I can.
That's right, and we will have the links in the show notes as well so that you can just click straight on them without trying to write down what Elio was saying.
Brilliant, thank you.
Elio D'Amato, thanks very much for joining me today.
Yeah, thank you, Phil.
Thanks for listening to Shares for Beginners. You can find more at sharesforbeginners.com. If you enjoy listening, please take a moment to rate or review in your podcast player or tell a friend who might want to learn more about investing for their future.